$83.5 trillion. I mean, just take a second to really wrap your head around that number.
Yeah, it's almost unfathomable.
Right. Imagine the sheer gravity of $83.5 trillion changing hands over the next 2 decades. Because whether you are, grinding right now, diligently trying to build your savings month by month, or maybe you're prepping for a large inheritance down the line, that volume of capital moving through the system is going to completely rewire how your money is managed.
It is a profound paradigm shift. We're standing at the edge of the largest intergenerational wealth transfer in human history, and it is colliding directly with unprecedented technological leaps.
Which is exactly why we're doing this deep dive today. We are looking at the collision of 3 massive forces, right? This great wealth transfer, the rise of a totally new breed of investor, and the dawn of agentic AI. And to piece this all together for you, we are pulling from a really solid stack of industry research. We've got a forward-looking McKinsey report on U.S. wealth management in 2035, the CFA Institute's research on next-gen investors, EY's analysis on leveraging AI in private banking, and Capgemini's latest World Wealth Report.
It's a lot of data to sift through.
It is, yeah. But our mission today is to synthesize all of this, to uncover exactly how the definitions of wealth, trust, and financial advice are transforming, and most importantly, what it means for your own personal financial journey.
Well, before we can unpack the mechanics of how this capital will be managed, we really have to look at exactly who's going to be holding it.
Right, the demographics.
Exactly.
Yeah.
The demographics are shifting so rapidly.
Yeah.
Out of that $83.5 trillion, Gen X is slated to inherit around $14 trillion, while millennials will see about $8 trillion.
Wow.
And right alongside that, due to intergenerational transfers, which basically means wealth passing between spouses and older generations, women will soon control over 40% of all U.S. wealth.
That is a massive demographic shift. And it significantly changes the face of the modern investor, right? I mean, according to the CFA Institute research, this next-gen investor profile, which they basically define as Gen Z and millennials, they are incredibly active.
Highly active, yes.
They are not the traditional, set it and forget it crowd. The data shows 63% of them are monitoring their investments on a weekly basis.
Yeah.
And 46% are executing trades at least weekly.
Right. And the sources they rely on to make those trading decisions, that represents a major departure from the past. They lean heavily into decentralized information.
What do you mean by decentralized exactly?
Well, instead of calling a traditional broker, they're pulling financial education from social media, native investment apps, finfluencers, and generative AI platforms.
Oh, right.
In fact, nearly a third of Gen Z and millennials have already used AI for financial education. Compare that to a mere 8% of the baby boomer generation.
So what does this all mean? If Gen Z and millennials are acting with this much autonomy and, they're pulling all their financial literacy from TikTok algorithms and AI chatbots, aren't they just kind of flying blind?
It's a fair question.
I mean, do they genuinely believe they've hacked the system, or do they still want professional human advice?
It presents a really intriguing paradox. Because outwardly, they project exceptionally high confidence in their own financial literacy.
Sure, they've got all the apps.
Right. But the CFA data reveals they absolutely still want professional guidance. Over 90% of them currently use some form of financial advice or planning service.
Okay, so they haven't totally abandoned the professionals.
Not at all. The catch, however, is that their extreme digital fluency makes them uniquely vulnerable to specific behavioral biases.
You mean because they're just constantly glued to a screen?
Exactly. They are immersed in real-time digital environments where it frequently looks like everyone else is getting rich overnight.
Oh, man.
Yeah. And that breeds intense FOMO, the fear of missing out. They are highly susceptible to trend chasing. The CFA report highlights that cryptocurrencies are the #1 FOMO-driven asset for Gen Z.
I can totally see that.
Yeah, they have access to infinite data points, but they often lack the historical context and really the emotional distance to process that data objectively.
Okay, let's unpack this.
Right.
We have next-gen investors who are about to inherit an immense sum of money. They're digitally native, but vulnerable to trend chasing, and they actually do want advice.
Right.
But here's the twist from the Capgemini report that really caught my eye. 81% of them plan to fire their parents' bank or advisory firm after they inherit that money.
Yes, that's a staggering statistic.
It's huge. If they genuinely want advice, why are they immediately firing the professionals who, already know the architecture of their family's wealth?
Because the way they fundamentally define the concept of trust has mutated.
Mutated how?
Well, Gen X and baby boomers tend to view trust through a relational and structural lens. They place their trust in full fee disclosure. They trust the fiduciary standard, meaning the legal obligation of the advisor to act in their best interest.
Right.
And they trust a firm personal handshake in a nice office. It is a highly interpersonal dynamic.
I see the distinction. So the older generation was kind of looking for a caretaker.
Yeah.
The classic mahogany desk, don't worry, I've got you covered dynamic.
Precisely. But next-gen investors define trust functionally and measurably.
Okay.
They demand strict, enterprise-grade data security. They want a mathematically proven track record of beating benchmark returns. They require absolute transparency regarding any back-end conflicts of interest. And they verify professional credentials rigorously.
So it's less about the handshake and more about the receipts.
Exactly. It is a stark pivot from a trust-me relational mindset to a show-me functional mindset.
That makes the data so much clearer. These next-gen investors want empowerment, not just management. They want relatability. They refuse to simply delegate. They really expect to collaborate.
Yes, collaboration is key.
It feels like the traditional wealth advisor was essentially a chauffeur.
Yeah.
You just sit in the back seat and they drive your money to its destination. But the new advisor, they have to be a driving instructor and a therapist rolled into one. You're both holding the steering wheel.
If we connect this to the bigger picture, that desire for collaboration is driving the evolution of the financial advisor into something much closer to a life coach.
A life coach for finance.
Yes. Millennials and Gen Z expect holistic life planning. They aren't just calling their advisor to check the yield on a municipal bond.
Right.
They want to integrate their mental health goals, potential career sabbaticals, and personal family milestones directly into their financial strategy.
Wow.
And curiously, millennials are increasingly utilizing both human advisors and robo-advisors simultaneously.
Hold on, why pay for both? I mean, if you have a human, why do you need the robo-advisor?
Because they view the two as complementary tools serving entirely different functions.
Okay, how so?
They leverage the automated robo-advisor for the low-cost, frictionless execution of trades and basic portfolio rebalancing. But they retain the human advisor specifically for that life coaching element.
The empathy.
Exactly. The emotional intelligence, the complex legacy planning, and the behavioral guardrails we mentioned earlier when talking about FOMO.
But that introduces a severe logistical bottleneck, doesn't it?
It does.
I mean, if clients now expect their advisor to act as a deeply empathetic life coach, spending hours helping them navigate career anxiety and family dynamics, how can a human advisor possibly scale that? They can't do that for a roster of 200 clients.
No, they can.
Especially considering, the McKinsey report points out, the industry is staring down a shortage of 100,000 retiring advisors over the next decade.
That is the exact friction point the industry is hitting right now. And the only viable solution to scaling that level of intense bespoke personalization is artificial intelligence.
Okay, AI. But we aren't just talking about the simple chatbots you interact with today, right?
No, not at all. The EY analysis outlines a rapid transition from basic automation, which, might save an advisor a few hours a week on administrative tasks, to what they term agentic AI.
Agentic AI. That sounds incredibly futuristic. What is the actual mechanical difference between the AI we use now and agentic AI?
Well, simple generative AI acts as an assistant. It helps you draft an email or summarize a PDF. Agentic AI, however, possesses agency.
Meaning it acts on its own.
Yes, it operates with a degree of autonomy to achieve a set goal. By 2035, EY predicts wealth management will rely on teams of AI agents that can autonomously reason, execute multi-step workflows, and actively manage portfolios.
That's wild.
Take something like tax loss harvesting, for example.
Okay, break that down for us. What is tax loss harvesting?
Tax loss harvesting is a strategy where you sell an asset that has lost value, specifically to offset the capital gains taxes you owe on an asset that has made money.
Oh, I see. So balancing the tax bill.
Right. It's mathematically complex and highly time-consuming for a human to track across hundreds of client portfolios.
Because the market is always moving.
Exactly. But an agentic AI can monitor the market tick by tick, instantly recognize a harvesting opportunity, calculate the exact tax implications, and execute the complex sequence of trades entirely in the background, without a human ever needing to click a button.
Here's where it gets really interesting. If these AI agents are doing literally all of the heavy lifting, I mean, if they're running the complex tax calculations, ensuring strict regulatory compliance, and executing the trades flawlessly, isn't the human advisor effectively demoted to a glorified customer service rep?
It seems that way on the surface.
Right. Why are you paying a premium for a human at that point?
It is a critical question, and it highlights a fascinating contradiction in the EY research.
Let's hear it.
Currently, 68% of banks foresee AI profoundly improving the employee experience, taking all that tedious math off the advisor's plate.
Makes sense.
But a mere 14% of those same institutions expect AI to meaningfully improve the customer experience in the near term.
Wait, really? That is a staggering disconnect. Why only 14%?
It comes down to systemic risk and liability. Institutions are terrified of privacy breaches, compliance violations, or an AI hallucinating and executing a disastrous trade.
Oh, yeah, a rogue AI losing millions.
Exactly. But beyond the fear, the core value proposition of the human is shifting entirely away from raw calculation. AI can perfectly optimize a portfolio's tax efficiency, but an AI lacks genuine emotional intelligence.
But wait, I have to challenge that because AI is getting incredibly adept at mimicking human empathy.
It is getting better, yes.
We already have highly sophisticated chatbots that act as digital therapists. Couldn't an AI be programmed with the right parameters to calm down a panicked crypto investor just as well as a human?
It can simulate the words of empathy, yes, but it cannot share the human experience of risk.
What do you mean by that?
An AI doesn't lie awake at night worrying about its children's tuition. When the market crashes and a client is in a FOMO-induced panic, or when a client is navigating the immense, often toxic family dynamics of inheriting $10 million, they don't want a simulated text response.
Right, it feels hollow.
It is hollow. They need the ethical grounding and the lived context of a human being. The human advisor becomes the necessary empathetic bridge between the flawless math of the machine and the messy, emotional reality of human life.
That makes a lot of sense. The machine handles the logic, but the human handles the weight of the consequences.
Well said.
So, with Agentic AI handling the logistics and the human acting as a strategic life coach, what exactly are they advising you to invest in? Because the sources indicate the underlying assets themselves are transforming to match the demands of this new demographic.
The shift is radical. The traditional 60-40 portfolio, allocating 60% of your money to public stocks and 40% to bonds, is effectively obsolete for this new generation.
Totally did.
Pretty much. We are seeing a massive surge in demand for private equity, real assets like infrastructure, and the tokenization of real-world assets.
Let's clarify why that is. Why does a 30-year-old next-gen investor prefer infrastructure and private equity over standard public stocks?
Because they are looking for tangible growth that isn't entirely correlated to the erratic swings of the public stock market. They want to invest in toll roads, green energy grids, or private startups.
But historically, those were out of reach, right?
Exactly. The barrier has always been that these assets require millions of dollars to enter and lock up your money for a decade.
Yeah.
That is where tokenization comes in.
Right, tokenization. That's the mechanism of taking a physical asset, like a commercial high-rise building, and using smart contracts on a blockchain to break the ownership down into thousands of digital shares, correct?
Exactly. It democratizes access. Instead of needing $50 million to buy the high-rise, you can buy a $1,000 digital token representing a fraction of the building.
That's incredible.
And because it's a digital token, you can trade it on a secondary market almost instantly. It creates liquidity in asset classes that used to be notoriously illiquid.
And this ties directly into the demand for crypto too, doesn't it? The CFA report notes that nearly 50% of next-gen investors plan to hold cryptocurrency.
Yes, the appetite is very strong.
But beyond the specific assets, the actual motivation behind investing seems to be shifting. Values-driven investing is taking center stage. The data shows 43% of young investors actively seek impact investments.
Right, they want their money to do something.
Exactly. They want to fund environmental solutions, social outcomes, and innovation. The old equation was just risk versus return. The new equation is risk, return, and values.
And this brings us back to how agentic AI changes the game. Because AI can handle infinite complexity, wealth managers can deliver that level of hyper-customization, screening thousands of assets for your specific environmental or social values at a massive scale.
Right.
This leads to the democratization of the family office.
Okay, explain how AI democratizes a family office. Because historically, a family office was a highly exclusive vehicle for the ultra-wealthy.
Extremely exclusive.
If you had $500 million, you hired a dedicated staff, a full-time tax lawyer, an estate planner, a medical concierge, and a philanthropy director, all literally sitting in a room coordinating your life.
Precisely. The mass affluent couldn't afford a dedicated staff of experts. But by 2035, AI agents will essentially replace that room full of human experts.
Wow.
Code will seamlessly coordinate your tax strategy with your philanthropic giving and their investment portfolio, offering the exact same holistic, interconnected services to someone with a few $100,000.
So we are basically handing every listener the keys to a billionaire's infrastructure.
Yeah.
Just powered by autonomous algorithms instead of an army of accountants.
That's exactly what's happening.
That is an incredible evolution. But are alternative assets like tokenized real estate and crypto genuinely going to replace the foundation of traditional stocks and bonds? Or is this just a speculative phase from a generation raised on the internet?
What's fascinating here is this is not a passing trend. It represents a permanent transition toward genuine global diversification.
Okay.
The Capgemini report emphasizes that we are moving into a multipolar global economy. Emerging hubs like Singapore and the UAE are rising as dominant wealth centers.
Right, the landscape is broadening.
In this environment, next-gen investors view alternative assets and crypto not as speculative fads, but as necessary inflation hedges and essential technological upgrades to protect their purchasing power against traditional fiat currency risks.
So if we look at the whole board, we have a new generation inheriting $83.5 trillion. They demand highly customized, tokenized, values-driven portfolios. They expect AI to execute the complex tax strategies, and they require a human advisor to act as an emotional life coach.
It's a tall order.
It fundamentally breaks the legacy business model of Wall Street. So who actually survives this transition by the year 2035?
It is going to force severe industry consolidation. The McKinsey report forecasts that the wealth management sector will morph into a barbell shape.
A barbell shape.
Yes, leaving essentially 4 surviving archetypes of firms.
Walk us through those 4 archetypes.
First, on one end of the barbell, you will have the multi-segment mega platforms.
Okay, the big players.
Think of the ubiquitous household name financial institutions that have built massive integrated tech ecosystems, covering everything from your daily checking account to complex trust planning. Second, on the opposite end, you will have boutique and specialist firms. These will offer ultra-exclusive, high-touch intimacy for the incredibly wealthy who still want dedicated human teams.
It sounds exactly like the evolution of retail. You are either a massive mega mall of finance, where you can get every possible service under one roof, or you are a hyper-bespoke luxury boutique that caters to your exact measurements.
Exactly.
But the mid-sized, middle-of-the-road department store that doesn't specialize in scale or luxury, that model is entirely dead.
That is an apt analogy. The middle will be completely hollowed out.
What are the other 2?
The third surviving archetype will be at-scale independent advisor platforms. These are entrepreneurial models providing the technological and compliance infrastructure for independent advisors who want to migrate away from the mega banks and run their own books of business.
Makes sense.
Finally, the fourth archetype will be AI-native digital wealth managers.
The AI-first firms.
Correct. Because of that impending 100,000 advisor shortage, traditional high-touch human advice will inevitably become more expensive and exclusive.
Yeah, basic supply and demand.
Exactly. These AI-native firms will step in to fill the immense void for the mass affluent investor who may be priced out of a dedicated human life coach. They will offer highly sophisticated autonomous portfolio management at a fraction of the traditional cost.
Wow.
This raises an important question. What determines which of these firms actually thrive? McKinsey emphasizes that the true winners will be the leadership teams who strategically reinvest their technology dividends.
By technology dividends, you mean the immense capital they save by automating their back office operations with AI?
Exactly. The firms that survive will take those savings and aggressively reinvest them into human innovation.
Right.
They must train their remaining human advisors to be highly emotionally intelligent, deeply empathetic life coaches, because as AI commoditizes the math and the trading, emotional intelligence is the only premium offering the machine cannot organically replicate.
What an incredible trajectory to map out. We started this deep dive looking at an unfathomable amount of capital, $83.5 trillion, preparing to change hands.
A historic transfer.
We explored how that transfer is mutating the very definition of trust, moving it from a firm handshake to strict data security and verifiable transparency.
Yes.
We walk through the mechanics of how Agentic AI will autonomously harvest tax losses and manage tokenized, values-driven portfolios, effectively democratizing the billionaire's family office for the rest of us.
It's truly revolutionary.
And through all of this technological upheaval, the human advisor doesn't become obsolete. They evolve into a necessary financial therapist.
It is a total reinvention of the architecture of wealth management.
And what this means for you, listening right now, is profoundly empowering. Whether you're managing a scrappy portfolio on a digital app today, or you're preparing to interview and hire a full-service wealth advisor, you hold the leverage to demand this level of hyper-personalized, values-driven service.
You really do.
You no longer have to settle for a generic, cookie-cutter 60/40 portfolio. The entire financial apparatus is actively bending to your expectations and your technological fluency.
It absolutely is. And as we conclude today's analysis, looking across all these sources, there is one final lingering implication.
What's that?
We know the technology is accelerating exponentially. By 2035, if distributed digital trust mechanisms like blockchain smart contracts and autonomous agentic AI becomes perfectly reliable, entirely error-free, and infinitely faster than any human brain at managing complex markets, will having a human advisor become the ultimate luxury status symbol? Will we gladly pay a massive premium simply to experience the flawed, beautiful empathy of human advice long after the machines have perfected the math? Something for you to think about until our next deep dive.